So good afternoon. It looks like this breakout session is rather popular. So thank you for attending this session. I'm Pierre Benesch. I'm a board member of the IR Club, and I'm glad today to host and have this panel with you. With me today we have Caroline Learmonth, partner at FGS Global. I'm sure she has a lot of experience of advising company how not to do mistakes in capital market days. I've got Charles Hamlin, founder and managing director at Quantifier, and I think it's all about data and feedback, and well, he'll talk through many details. And we've got the market voice, if I may say, with Andy Schneider, who's the head of research at Z Capital in Zug. Thank you very much. So what I suggest to do is going first and maybe give you my own experience. Of course, I used to be an IR player, and I went through a number of CMDs. The first thing, obviously, which is not covered on the slides, is basically the topic. How do you select the topic? And this is obviously something you don't do on your own. You do with your management team, but you have certainly a role to play, which is basically thinking about what you have been hearing from investors and the investment community, from analysts, what you think is the best topic. Of course, I won't cover this one because it's not entirely in your hands, but this is something, of course, quite critical. The second thing is, in my view, how do you position this capital market day? Is it going to be an investor education event, or is it going to be something that will or could move the needle in terms of your share price? It's quite important to figure out before you do it. And thirdly, of course, it's about the frequency. How often do you do it? As we all know, sometimes less is more. But again, it all depends. So having said that, I've put on a couple of slides just some thoughts from my past experience. And my most recent experience, for those of you who don't know me, I was head of investor relations at Givaudan, and we would do at least 2 capital markets a year. So quite a lot, but of course with a very specific angle and specific view. Again, I'm not telling that you should do 2 CMDs a year, thank God, I suppose. But again, I mean, I have some experience of that, and I had the experience of doing CMDs in other industries and other companies. So basically, the first thing is, as I said, and I think that was something that Geraldine said earlier today, it's quite important. You need to strike a correct balance between the investor's expectations and your own corporate objectives. Again, I mean, it's not just about telling investors what they want to hear or just being right spot on the sort of recent headlines. The second thing is, when you decide with management team, with the C-suite to go for a CMD, you need to be sure that you have something to tell. I mean, it sounds obvious, but the last thing you want is that people walk away with really a deep disappointment that they haven't learned anything. And for me, that's the most critical risk, that the content is not there. So I think that's one thing, which is when you talk internally to your teams, to the management, to the operational teams. And the second thing, as I mentioned earlier, is to set or try and set the right expectations with the market, because you will get the question, and you've got the question many times, well, is it going to be a catalyst? And you will read in sell-side reports, next TMD is coming up, and it's got to be a catalyst. Well, what catalyst are we talking about? So just set the expectation in the right place. And then, as we all know, as IR professionals, I think it's important that you put operational teams close to the market, at least for that instance. I mean, they're used to meeting with the CEO, CFO, etc. I mean, that's part of our routine. But equally, as you know, they are very keen to talk to the real operational people in the field, the ones who are really earning the company's money on a day-to-day basis. Then, on a more practical way, be careful about the location. Of course, you have a message to convey. There's a meaning about the location. You choose a place or you choose a topic for a specific purpose, but you need to be aware that, I mean, time and money is a limited resource, and not all investors or analysts can afford spending 2 or 3 days flying to the other end of the world and paying costly airline tickets. And finally, on this, duration, the length of this investor day or capital market day could be a day. Of course, if you're flying to some other place with a different time zone, might make sense to have at least a day and a half. And please allow time for social interactions, meaning a welcome dinner and a lunch, although it might be a quick standing lunch, whatever, but an opportunity to talk with the management and the operational teams. So that's my sort of personal experience. And to go one step further, which is about the preparation of the capital markets days, this is a very, very demanding project. So it has to be organized as a project. And again, in my experience, it takes about 3 to 4 months. And you need really weekly progress meetings. Well, that's I'm sure that Caroline will probably agree. I can't speak for her. But certainly this is a project, and you need to be very, very strict and even very tough on time and that kind of things. Stable project team. The last thing you want, again, is that along the way there are some dropouts, and of course we don't want that, because then you'll have to start again, and that's a waste of time. You need to focus first on the content before trying to make nice slides, nice pictures. I think the content is key. Nobody will blame you if the picture is awful. Of course, I mean, the corporate comms team might mind, but probably not the analysts. So you need focus first, for the first 3 months at least, on the content, and anticipate logistics. And that's part of our jobs, basically, but I would say by the minute, and put yourself in investor shoes. And I mean, you always have people who are late, show up late, or whatever, and so you need to be careful and figure out a plan B, because you have in your teams, in the teams of your company, good speakers, not so good speakers, people who talk too long, etc. And basically, you can ruin your schedule. So you need to constantly look at your watch the whole day. That's a very painful exercise, but you have to do this. And lastly, I would say in the preparation work, it's paramount that you set a number of do's and don'ts that you share with the operational teams. I mean, your CEO and CFO probably have some experience, and they most likely have the experience of the investment community, but the regional or operational managers that you'll deal with don't have that experience, and you need to teach them how to behave. I mean, it's not 100% risk-proof, but at least this is a must-do action. And finally, and sorry, I don't want to be too long, on the day, of course, as I said, timekeeping is critical. You also need to be clear on the rules with the investors and the analysts, because again, I mean, and I had personally this experience a year ago that for logistical reasons, we had to do the CMD a week before the third quarter trading update. But if you're clear enough with the audience that we will not speak about the third quarter today, I think people are fine with it. And there's no reason why there would be any risk or any leak, and particularly from these regional operational teams. They have no clue about what we're going to publish at group level. So, but you need to be really clear on that. Obviously, I don't want to say that IR people can be sometimes a bit paranoid, but you need to keep an eye on some unwanted questions and hear what's going on here or there, and maybe run and stop any slippery or dodgy conversation. And finally, post-CMD, well, there are a bunch of tools which are quite usual: press release, web story, social media, and last but not least, of course, feedbacks and surveys and different things. But I'm sure that we'll have this conversation. So that's at least the IR officer's experience. So I don't know, Andy, if that rings the bell with you. And
I'm the proponent of these slippery conversations.
Of course, you like that.
Yes. No, just a few comments on what you said. First, obviously the topics are quite important. The most important thing, and we will talk about that later too, but the party said that we are not talking usually about current business development. Whenever it's possible, we want to talk about current business development. So it's not ideal to have a CMD 1 week prior to the numbers or during the quiet period anyway. So whenever it's possible, you should also have to have the opportunity to talk about it. It shouldn't be center because you have your message you want to bring across, and that's fine. But whenever it's possible, we want to talk about it. That's certainly one. And then probably one thing on the location you mentioned. We are a small independent company. We usually have enough budgets and enough people. We can travel wherever we want to travel. But especially in bigger organizations, bigger bank these days, travel is heavily restricted. Hotel prices are heavily restricted. So keep it local if you can keep it local, and turnout will be higher, which might also mean that making 1 year a local one in Zurich, because that's the home base, but 1 year it can be also in the UK or stuff like that. But that gets more important and wasn't a problem 10, 15 years ago, but it's certainly today. And to that, announce it very, very early on. Save the date, beginning of the year or 6 months in advance. Even better if it's already a little bit detailed. So it's only the afternoon or it's afternoon and dinner, so that people can be prepared. Because a lot of investors work in teams of 2, 3 people, so the calendars fill up quickly. And then probably the last point I want to mention, you mentioned post-CMD press release. We like it early on. Press release in the morning, presentations also published in the morning. Yep. And I think that's quite important because that will make the discussions afterwards, the question Q&A, will make it much better because we already had time to prepare and go through the material.
Okay, no, thank you, Andy. And I'm sure that later on in the discussion, you'll tell us what kind of things you would not recommend to companies to do, so the do's and don'ts. Anyway, so Caroline, I mean, you've helped many companies. I'm sure you can share a wealth of experience with us.
Well, I hope so. So moving on from an advisor point of view in terms of how to help companies and IR teams in particular prepare. And of course, other than the first thing you do is you hire FGS Global to help you. The second thing you do is you look at this. Now, And I was talking to Geraldine just briefly before she made her excellent speech. And we were agreeing, I mean, it's not rocket science, is it? I mean, we're all intelligent people here, or most of us. We're all professionals, we've all got experience. You know, in theory, it shouldn't be difficult to do this. We know what we want to do. We know we want to be simple, clear, concise, impactful, all of these things. So therefore, why is it so difficult to do this? Why is it so many hours, so intensive? And I've literally just flown from the middle of preparing for a Capital Markets Day, and it is absolute chaos. And what I wanted to tell you was, rather than read you some of the things on this slide, which are the key things, I was just going to flag some of the things that, you know, from bitter experience, and not just in this process, from other processes, can go wrong. So, you know, what are the learning points? So, kick off, get the relevant stakeholders together at the start, get them aligned, decide what are you going to talk about, what are the messages, what is the strategy. You'd be amazed, or maybe not amazed, how many companies can't agree on what the strategy is, or what the key message is, or what exactly they want to say. So avoid last-minute disagreements on this. Do it up front. And that goes to the speakers. Decide who's going to be speaking. Why are they going to be speaking? Are they used to speaking to investors? If they're not used to it, they need to be trained. They need to be rehearsed. They need to have several sessions, not just one last-minute thing on the day before, in order to come across in a really impactful way so that people like Andy can appreciate and understand what is being said. On the messaging, and here it's important to really think about, what are you going to say? What are the investors worried about? What do they not understand? What are they telling you that they don't like? And of course then, you know, a pre-Capital Markets Day perception study from someone like me or someone like you is very good for getting that granular detail and factual issues that you need to address. Of course, you need good content, you need good slides, they need to look good. Don't just think about, you know, your competitors, your peers. Think about best practice more broadly. I think Geraldine mentioned that as well. Just, you know, don't make it difficult for people who are time, what do you call it when you haven't got any time? For people who haven't got any time to understand your story. Logistics is super important. You know, wherever it is, get a venue that's going to be good, is used to doing this sort of thing. Even a venue that's relevant to your company. If your company builds things or whatever, try and have even a project that's relevant to your company. But if you're in a hotel, whatever it is, it's got to be super slick, super professional. Timing, invite out really, really early, exactly. Don't clash with the 8 million conferences that are going on, you know, nowadays, and with the 100 other capital markets days that everyone does. So maybe moving on quickly to the content. So you've got to have the right content. It's not about, you know, strategy consulting, marketing. It's about simple, market-friendly, investor-focused content, the stuff that Andy and his colleagues will like. New information. Don't just talk about stuff they've heard before, or they will be really irritated. New strategy, new target, new CEO, new deep dives, whatever it is, it's got to be something new. Really effective, really efficient, really concise, really simple to understand. Time-poor investors looking at 100 companies, sell-side analysts looking at 20 companies, whatever they're doing. They need to have things that are really easy to understand. Benchmark against best practice, I mentioned. Be credible, be granular. Everyone's talking about innovation, AI, R&D, digitalization, sustainability. Don't just talk about those things on a nice slide with pictures. Have granular information. What do you mean? What's the impact? What are the KPIs that investors can understand? How is that going to impact your investment case? Are you going to report back to us on what you've been doing on it? It's not good enough nowadays just to have some wishy-washy words. I'm glad you're enjoying it. Oh, sorry, I've gone the wrong way. Make the financials easy. So I used to be a sell-side analyst at one point, so I can say this. Analysts sometimes are not always diligent. They can be lazy. They cannot spend enough time. Make it super easy for everyone to understand. And then obviously have the interesting bits. So are there product demos? Are there breakout sessions? If you've got super cool product, then put that in the lunch area. I did a capital markets day for a chocolate company, so everyone was really excited about the breakouts and the lunch. And with that, I think that's the end of my session, but Andy is now going to disagree with everything.
No, I actually agree, and also talked in preparation for this session. I also talked to some of my friends, the bigger investors here in the Zurich area, and also some of my teammates and some analysts. And then there was a big agreement that you shouldn't do a CMD if you don't have to have something to say, right? It really has to be an impactful message. New targets, that's obviously a no-brainer, a new CEO. But it can also be a deep dive on divisions. But what a lot of people said, and I think that happens too, oftentimes too many topics are covered. I would prefer to go to a CMD and just learn about one division, but in much more detail, about the competitors, about the supply chains, about the clients, risks and opportunities, and also in terms of messaging and detail, what you mentioned, I totally agree with that. Do not just talk about the 100 basis point margins you want to increase. Give us the bridge, the 3 buckets that's usually done, but then go into these 3 buckets. Tell us about the process, how you came up with these. Like a good example would be, okay, we have this 50 million cost-cutting program, and we had a top-down target and had bottom-up committees, and we came together, and we have now 12 fields, 12 buckets of measures. Each bucket has 10, 15 measures, and each measure has a KPI, and the committee looks at it every second week. The CEO, CFO come in every month or every other month, and update the timelines, look at the impacts they already made. If you, without giving us too much detail, just talking about that process, every cost-cutting program, every margin improvement program gets much more tangible for us and will leave a much bigger impact than just a number and the 3 pillars it's built on. So a little bit more detail is always good. And I know that you guys don't want to give too much detail usually, and we usually want too much detail, but I think there is a middle ground where you can tell a lot without telling too much. Using also in that restructuring case I just mentioned, using also some measures you already did. And you can tell us about that. We did that and that and that, and it had this impact. And just with some anecdotal evidence on top of the numbers and the pillars, your messaging gets much more credible and leaves a bigger impact.
Okay.
Good. Well, thank you, Andy. So,
Perfect.
Charlie, over to you.
Thank you. So I need to start my bit with a confession, which is that I have never personally been involved in organising a capital markets day. I haven't attended very many, and I certainly don't get paid for advising on this topic. The reason that I'm here today is because Quantifier specialises at collecting feedback from investor communities, and we do that using technology and systems in order to harvest and analyse that feedback information as data and at scale. So what I'm going to do today is to share some insights with you from feedback that we've collected from investor communities following CMDs. Now, before I get into that, I just want to set out a little bit of context for you based on some analysis that we've recently done. And it might be reassuring to people in this room that there is, in fact, a relationship or a correlation between the feedback that we get from investors and what investors subsequently do. So just to help to make sense of this chart, Quantifier produces a net confidence score. Okay, it's the summary, or it's the average of 3 different confidence measures that we capture, and we work it out on a scale. Don't worry too much about the numbers. We work it out on a scale that goes up to 100. So to understand what's happening here, if you look at the score that is 44, a confidence score of 44, what this chart is telling us is that approximately 95% of non-holding investors, when they've given feedback through our service, have a confidence level which is at 44, which is at 44 or less. Sorry, I just got slightly modelled up there. Whereas if you move to a confidence score of 83, only 5% of non-holding investors report a confidence level that is 83 or more. Whereas if you look at the holder data there, you can see that almost 80% of invested investors who've given feedback have had a confidence score that's been 83 or higher. And going the other way, it's only sort of 3 or 4% of holding investors who have a confidence score at 44 or less. So what this is really telling us is kind of what you would expect, which is that there is a relationship between sort of confidence and ownership. And what's quite interesting about that is that there's a very clear tipping point on our scale at 72.2, above which investors are much more likely to be invested in your company, and below which they are much less likely to be invested in your company. So I just needed to introduce that concept of confidence as a measure and the tipping point for this presentation. Now, to bring this onto Capital Markets Days, I realise this slide looks a little bit complicated, so bear with me. It's actually talking about a fairly simple idea, which is that we've found that there is a correlation between change in a company's net confidence score and the subsequent direction of the share price. Pains me that Quantifier is not a hedge fund, as I tell you that. But this is quite interesting information from an investor relations perspective. So what you're looking at here is a scatter plot where we've been able to identify a before and after change in a company's net confidence score. And then at the date that we identified the change, we then looked 3 months later on to see what had happened to the share price. So for the statisticians amongst you, there's a correlation coefficient of 0.3 and a confidence level of 98%. I'm not a statistician, and for the non-statisticians among you, that basically means that there is a high likelihood of a low to moderate correlation in this data. What this really means for you as IRs is that if you're able to move the needle on this measure of confidence, then you can realistically expect that to be realized in the share price over a period of time. And in this particular data, I've highlighted where we have collected feedback following a Capital Markets Day, and we're able to measure a difference. And there are 10 instances there. And so what we can see from that data, and look, it's early data, we'll continue to build it out and analyze it, is that on average, a Capital Markets Day yields an increase of 8% in market confidence, and that also manifests as an increase in 5% of an improvement in the share price over a 3-month period. So quite interesting, and to the extent that you guys invest a lot of time, effort and resource into putting these events on, may be helpful to understand that, particularly if perhaps you're negotiating the budget for your next CMD with your CFO. So to look at the feedback that's come through, so we're collecting feedback in a quantitative and qualitative context, and so we've done some analysis categorizing the comments that have come in from investors post CMD. And here on the left is the list of the top 10 most frequently commented topics. And no surprise really that some of the articles at the top there. And then what we've also done is broken this data out. So the orange data is from those investors who have a confidence level above the tipping point, okay, and the grey data is those unconfident investors. Now, this type of analysis inevitably, naturally, lends itself much better to a sort of an individual company, but there is something I think that we can take away from the aggregate of all of this stuff, which if we look at the unconfident investor group sort of topics, we can see that there's more focus among those people on market conditions and competition and on financial performance, which is where you might expect a more skeptical mind potentially to go. And so if one of the objectives of your event is to sort of solicit investment from new investors, then it stands to reason that it makes sense to have very good and clear content in those areas. Now, I'm conscious that I just landed quite a lot of data on you, and so something just a little bit lighter to conclude with. There is, in fact, a data-driven playbook for CMD success based on an analysis of all of the feedback that we've captured for all of our investors on these bottle openers which you might have around your neck. I didn't think it would be fair in my final slide to put 50 recommendations on here, so I've limited myself to 3. So the first is to, just like with any event really, is to try to include an element of entertainment. Certainly, we do see lots of comments from investors where there's been an interactive component that's helped to bring the business to life. That's often a very positive thing. I don't know that that second comment is necessarily from somebody who was properly entertained, but it doesn't really matter for the purpose of this. Look, they say an army marches on its stomach. I think that appears to be the case for investors as well. We see lots and lots of comments on the catering. And then
that
finally...
must have been the chocolate one I was talking
could
about.
have been chocolate one. And here you can probably see why I don't get paid to give advice. But it's one of the things that comes up once in a while as well. So, yeah, that's what I have to share with you on post-CMD investor feedback.
Interestingly enough, when I asked all my colleagues and also some analysts about how many times they were asked to give feedback after a CMD, the answer was not many times. I had one person out of 18 who said, yeah, quite regularly, and everybody else said very seldomly, and some said even never.
It's amazing.
And oftentimes, with IRs, with managements, they will ask you, and you will give feedback to them directly. But that's usually a few words or one good and one bad point. And oftentimes, and same is also true for the preparation. You said also to hire somebody there to make a perception study or so, which might not be wrong, because oftentimes, and I see that in small group meetings, in group meetings with other investors. Investors are afraid to ask some tough questions sometimes, or give really honest feedbacks if it's not very positive, or the feedback is too positive. And that's why perception study prior to the CMD, and also a study for a feedback study afterwards from an external source too, makes a lot of sense to me. And then probably on the last slide, we like food and booze, obviously. and I think, and that's also what a lot of colleagues told me, that's really an intricate part, because during the dinner or during the lunch, during the breaks, you have the opportunity to talk to all the people there, to the management, to the business units head, or even to some regular blue-collar worker who are there to present something. And that's really, really valuable, because we all know every investment starts with management, with the people. Either you trust them or you don't trust them. And for you guys, for the companies, there might be some investors who do not trust your management, but they might trust you and are still invested because of that, or are not invested because of that. And then if you show them some business units head, they might get that confidence they need. They don't get from the CEO or CFO, they might get it from the business units head or division heads. And that might bring them to the tipping point and make them shareholders. So I think that's really important for a lot of people. That is really important. If you do dinners, if you do lunches, do not do sit-down dinners. Make walk-around dinners so that everybody can mix. And one nice little fact that happens there too, especially with some booze involved, is some of your investors might do the job for you, because they talk to the other investor there. And they say, have you seen that? And that is really, really positive. And I think I'm long because of that and that and that. So they might work there. And the analysts who are there at your CMD, they obviously do that, because we talk to them there too, and during the dinner, and about what we've seen. And that's probably the last point to that too. It's ideal if the drinks and dinner is after the presentations, because then we have all the new content and can discuss it. If it's the day before, sometimes logistically it has to be the day before, but if it's the day before, we don't know yet what you will tell us. all the news, and we cannot discuss that. And that's often also for the management, that's often putting them into an awkward situation.